You have $3 million and you don't want to pay taxes in retirement. I'm going to show you how. Hey everyone, I'm Andrew. I'm a chartered financial analyst, charter holder, and a CFP professional who has dealt with ultra high net worth clients for the last decade and a half, give or take. And I make these videos to take the learnings from the many reps I've had in those complicated situations and bring them to you. So in today's video, I hope that's not too clickbaity of a title. I'm trying to win the YouTube algorithm these days. And I just had this idea while I was driving the other day that, you know, you could actually have a $3 million net worth and not pay any taxes during retirement. And when I say taxes, I mean like capital gain taxes, income taxes, that type of thing. Obviously you still have sales tax, property tax. All the other taxes are beautiful government levies on us. So you have a $3 million investable net worth. $1 million is in a non-qualified account, $1 million is in a traditional IRA, and $1 million is in a Roth IRA. How are you going to get through this without paying any taxes? Oh, Andrew's a liar, isn't he? Au contraire. Here's what you're going to do. Let's just say clients are 60 years old. The Roth's been in existence for a little bit. The non-qualified's been in existence for a little bit. They just rolled over the IRA because they retired. And obviously they're not Social Security eligible yet. Okay, what are you going to do? One, you've done pre-planning. You have 0 stocks in your non-qualified investment account. In your taxable investment account, you have no stocks that pay dividends. That's number one. Well, where are those stocks, Andrew? They're in your Roth IRA. Okay. You also, number 2, have no bonds in your taxable investment account. It's only growth stocks that do not pay dividends. Number 2, your IRA is holding the majority of your bonds. Why? You don't want an RMD issue in the future. Okay? Number 3, your Roth IRA has cash flow immunization for the next 3 years to 5 years of fixed income, and the rest in dividend paying equities, emerging markets, real estate, the other diversifiers that you don't want in your taxable account. So, if we just say the first several years of retirement, you want 50 grand every year, you're pulling from the Roth IRA. Andrew, that's the wrong thing to do. You keep the Roth IRA for inheritance for the kiddos. Keep watching. You pull from the Roth IRA, you keep doing cash flow optimization on a 6 to 12 month basis. You have no taxable income those first several years of retirement. So from age 60 to 70, what you're going to do is ladder Roth conversions from your traditional IRA all the way down to your Roth IRA, taking into account your standard deduction. Okay, so I'm going to do at least $30,000 a year. Now, over 10 years, that's $300,000. I'm mostly in bonds, so I have lowered the amount in my IRA. I know I have charitable intent, and I know I have legacy intent. How am I going to handle that? Well, fast forward, age 70, I have the $50,000 a year from the Roth IRA. I've drawn down that Roth sum. Now Social Security hits. However, because my taxable account still does not have any tax liability associated with it, because I've been pulling from the Roth and I only have growth equities that don't pay dividends, my provisional income for Social Security benefits is incredibly low. So, I'm not paying any taxes on that. Provisional income, if you don't know, is your adjusted gross income, plus half of your Social Security benefit, plus any municipal bond interest. Well, we knocked down the AGI, we don't have any municipal bonds, so it's just half your Social Security benefit, and if you're under $32,000, you have no tax liability. So if my Social Security benefits $60,000 a year. Half of that, 30, I have no tax liability with it, okay? Age 73 hits, now I have required minimum distributions, but I have charitable intent. And over the last decade, I've moved money from that IRA account over to the Roth each year. So it's still worth $1 million, but I start gifting my required minimum distribution through the qualified charitable distribution. And the charities are getting the money tax-free, and I'm not having to pay the tax on that. But I still know I want my kids to have an inheritance. Well, I now have Social Security paying my basic income needs. I have the remainder of my Roth IRA, okay, for any variable expenses. The IRA is going to charity every year right now through my required minimum distribution. I haven't touched my taxable account yet, okay? It was $1 million, now we're 10 years into retirement. It's probably, you know, depending, it was growth stock, so let's say it's $2 million now. Seems fair. Fast forward another 20 years, it could be worth, you know, 7, 8 million. I'm doing this math in my head, so give me a little grace there. But the special thing is my kids will get a step up in basis when I die. If my basis was $500,000 in the taxable account, whenever I die, it's $7 or $8 million. The charity's gonna get the rest of my IRA. The kids will also get the Roth IRA if there's anything left. And then they have to take it out within 10 years, but there's no tax liability. So I just walked through retirement because I drew from my Roth IRA first, all right? And then I made sure my provisional income was low through Social Security, and I laddered Roth conversions in the meantime to keep bolstering and replacing some of my income. I gave my RMD to charities, and then eventually I make the charity my beneficiary of the IRA, and my kids still get the inheritance over here, plus any residual in the Roth IRA. It's a complete hypothetical scenario. Again, I was driving yesterday and I thought it up. I thought it was interesting enough to share. Those types of situations are real, and I think it's illustrative of how rules of thumb are somewhat right, but never completely right, because it's also individualized. So there's a quick way. If you have $3 million to get through retirement with paying very, very little tax, you know, it's an interesting thought experiment. So hope you enjoyed it. Thanks.